Welcome to another episode of the Payment Strategy Show. I'm Joshua Silver, founder and CEO of Rainforest. We help software platforms embed payment processing into their core products to grow revenue and improve customer retention. I'm here today with a good friend, Colin Luce. He is the co-founder and CEO of Basis Theory. They are a fully programmable vaulting solution that helps software companies and merchants keep control of their payments data. We've got a great show ahead. Welcome to the show, Colin.
Thank you. Do you go by Joshua or J Money?
Do you have a good story to share with our viewers about that?
I don't, although it's very fitting for what you guys are doing at Rainforest. I always see you post as Joshua, and I think, people should know you also, go by J Money.
Only in the presence of Colin at Basis Theory, so that's a good
All right,
nickname.
fair enough.
But
No, thanks for having me. Super pumped.
Colin, tell us a little bit about your background. How did you first get into fintech?
I wish it was more intentional. The reality of it is I graduated college in 2008, which if you recall, there was a lot happening in 2008, namely this global financial crisis. Moved out to San Francisco, and I think the fortuitous aspect of it is I wasn't tempted to go into banking or consulting or some of these traditional paths, namely because they weren't really options then, right? People were not
Right.
hiring in 2008, they were firing people. And at the same time, kind of dumb luck when I moved out here set me up with a company that was building banking software called Yodlee, which people may now know as the original V1 version of Plaid. I joined them to build out the non-banking side of their business. This was right around the time of Mint.com and Venmo and LearnVest and all of these interesting companies. And so I ended up having this really unique platform where all of the builders in fintech had to at least come have a conversation with us at Yodlee. And so I got a really wide purview on kind of where this nascent fintech thing that was going, which was awesome. And then stuck around there for a few years, and right around the IPO, left and joined what was at the time a random Swedish invoicing company called Klarna, still only existing in Northern Europe and the Nordics, and helped launch their UK and then their US market, which really kind of gave me a crash course more into the payments side of fintech more acutely.
That's awesome. Almost every guest we have on the show talks about they fell into payments. I think almost nobody gets into it intentionally. So you're in good company there, certainly.
Totally. I see it
To,
now, right? It's like you're at dinner conversations with family and friends and you start talking about it and like they can't move on quick enough, right? So I think that's good.
exactly. But at the same time, I found once people get into payments, the payments vortex keeps sucking you back in if you ever try to escape and go do some other profession or industry. So it seems like you've accepted your long-term fate is in fintech and will be there for a while. So glad to have a fellow payments nerd on the show.
Yeah. No payments nerd tattoos for me, but you can, assume I have a tattoo.
Fair enough. What inspired you to found Basis Theory a couple years ago? What problem did you set out to solve?
A lot of it stems from my tenure at Klarna. When we set up the Klarna North American business, we set it up as a registered payfac. We were building on top of what was at the time Vantiv. And I saw a lot of the pain points associated with that. Now, we were very fortunate that we had this, cash cow profitable mother entity sitting over in Europe that was generating real cash flow that was funding us. And so we didn't have some of the constraints a normal startup or small business would, but it made me quickly realize like how on earth do these companies navigate this and get started under the guise of not having the luxuries we had. So that was part of it. And then over the course of several years, working with these very large global merchants and marketplaces, I started to notice this shift towards a multi-PSP, multi-processor strategy on a global basis. And this was 8 or 9 years ago at this point, maybe even 10 years ago. And so it's been a long trend and a long journey. And I think we're still early in that journey, frankly. But even witnessing it back then, I remember talking to merchants on a quarterly basis, and they, especially the bigger ones, had these like quarterly innovation offsites, right? And they'd come back and they'd tell me that quarter and quarter again, the number one thing that would come away from these innovation offsites, on the payments front is like, how can we reduce our cost of acceptance And then they basically say, but we just throw our hands in the air and we feel like we're trapped and there's not a lot we can do. And so it seemed like there was an obvious opportunity there and a big problem to solve.
So it sounds like it started in a lot of ways with cost optimization and reducing cost there. I would imagine years later now, it's a broader conversation besides, hey, how do we save costs? What has that kind of evolved into?
Well, I think a lot of it stems from, and we were kind of touching on it a minute ago as we talked about, like, once you fall into payments, it's hard to get out of it because it's this like never ending onion that you keep drilling down on. And I think for folks that are newer to it, and historically, remember, these merchants didn't have a dedicated payments org or a payments business unit, right? They pulled someone from finance, they pulled someone from ops, they hired a consultant to look at payments. And when you look at it on the surface, you're like, oh my God, we're paying 2.5%. Like that seems high. And so I think to your point, like the original inclination is around optimizing cost. I think when you start to understand the breakdown of what is actually included in the cost and who the beneficiaries are between the issuers and the networks and the processors, and frankly, all the benefits you get from those trusted intermediaries as it relates to fraud and chargebacks and all these different aspects. Like one, I think they realize it's actually not that high. And two, I think they also realize that the actual margin of opportunity to optimize is rather limited in that context. Now, I think they similarly, though, as part of that journey, start to realize there is a lot more they can do with payments. It just might not result in a reduction in cost. And so I think even today, and I think we'll talk about it at some point, this, hot buzzword or topic of payment orchestration, like everyone immediately thinks payment orchestration is about least cost routing. And it's really not. When we talk to merchants and platforms and marketplaces, the hierarchy by which they're thinking about payment optimization, orchestration, et cetera, frankly, first and foremost starts with redundancy, right? And I think that stems from the start of this conversation, the global financial crisis, and the pain of being reliant on a single financial institution. I think we saw that peek its head out again in the SVB crisis. And I know, you are, had a front row seat to that. I think more recently with Adyen's outage, Braintree had an outage in Australia, WorldPay having, like, just this concept of redundancy and resiliency is actually the first reason why they go down this path. And then I actually think what we tend to see is more interest in performance optimization, authorization rate optimization, conversion optimization in advance of really thinking about or optimizing costs. Now, I will caveat all that by saying it's highly dependent on the stage and maturity of your business, the markets you operate in. But I think in general, that's what we tend to see.
And break it down for us. What's really the difference between vaulting and orchestration? Like just crash course 101. What's vaulting? What's orchestration?
So look, I have a hard time answering that question in the way I think you want me to, which is like not getting deep into the architecture of it. The reality is, I think that's kind of where we have to go. First and foremost, I actually don't think there is a generally accepted or agreed upon definition of what payment orchestration is, or the ways in which you can enact a payment orchestration strategy or enable it, right? I think there's a lot of confusion in the market between the concept of payment orchestration and the ways in which these payment orchestration companies or payment orchestration platforms are being delivered into the market. Those are two separate things, but they're being commingled as the same idea. And so I think if you talk about it from a conceptual level, payment orchestration is all about the ability to dynamically route data and payment credentials across multiple different partners or multiple different parties. And I intentionally say data and payment credentials because that doesn't just mean routing payments across multiple different, PSPs. It also means routing data off to fraud providers. It might also mean embedding analytics and third-party dashboards into your overall approach to this and enabling your data scientists. It might involve including a billing provider in there. Like this overall payment stack has been decoupled or is in the process of continually being decoupled. And so the ability to dynamically cut across and build your own custom payment stack in an open, dynamic, flexible way. That's what payment orchestration is. Now, to your point, I'm biased because I'm building an approach to this with vaulting as opposed to a SaaS service for payment orchestration. But these payment orchestration platforms deliver all of this in a box behind a single API. And look, I think there are real inherent tangible benefits to doing that. I guess the big question I have is, going back to my previous point, if redundancy and resiliency and relieving the burden of having a single point of failure is the number one reason you're going down this path, then does it really make sense to move that single point of failure from a single PSP to a single orchestration layer? And I think that's where the jury's still out, frankly. And so we take a very different approach, which is deliver the vault as a service to our customers, where we abstract away the complexities of security, compliance, the risk associated with all of that, and give our customers essentially the tools through the different SDKs, APIs, services we offer to build their own orchestration layer. And so I think in the context of market dynamics, various different third-party players in the ecosystem, I would think about it between a wholly managed SaaS offering versus infrastructure in the case of a vault that allows you as the merchant or the software platform to build your own orchestration layer or build your own internal orchestration platform.
What would you say to listeners who would ask you, you're saying don't transfer the single point of failure to an orchestration platform. Is it them just transferring to you, though, as a vault, a single point of failure? I know you service many really, really large name brands that we all know and have really been able to penetrate that segment quite successfully. But what do you tell them? How do you get them over the hump of now you're the single point of failure?
Yeah, for sure. And over the evolution of the past 4 years, like, we've adapted a lot to meet the demands of our customers and of the market on this exact point. I think that there are aspects of this that are both technological and business oriented. So first and foremost, our business model is not predicated in any way on transaction fees, API calls, anything like that. We take a very different approach, which is thinking about this more as true infrastructure and charging a SaaS fee for that. So I think that's an aspect of it where our customers feel like they're not constrained to make routing decisions or otherwise based on the associated costs of the third party. And so I think there's a business model aspect. From a technological or architectural perspective, we think a lot about this. And I will say there is a direct and inherent tie to the business model in this, because I am not, monetizing my service or my value by transaction fees. And so I can actually work with my customers to implement basis theory in a way where I don't want to be in the middle of every transaction. Like, where are the ways or where are the places where I can actually get myself out of the equation and be less of a single point of failure? Now, look, admittedly, and to your point, there are circumstances, situations, and parts of the customer journey where I very much am a single point of failure. But from a KPI perspective, we approach it internally as how can we bring down the number of times or the places in which we are a single point of failure. And so one of the things we do is, and again, this is kind of the next level down on your question around orchestration. I think the market refers to orchestration or thinks about orchestration from the context of transaction orchestration. Mm-hmm. We've taken a different approach, which is we think about it more from token orchestration perspective. Sure. And what that allows us to do is leverage the unique and individual tokenization practices that each individual network, processor, acquirer, or third party uses. We help our customers bring the raw data out to all those various different third parties in a secure and compliant way. But then we just bring back the associated tokens and we let our customers store those on their own side. They're no longer sensitive. They're no longer subject to compliance requirements. They're no longer introducing, this liability scope on their end. And in that way, we're going to be involved on the initial card capture, the initial onboarding, the CIT aspect of it. But on all future and subsequent transactions or MITs, our customers are able to share, interact, and process with these various third parties without basis theory being in between or in the middle. And so that's where we focus on it from a technological perspective.
Yeah, it makes a lot of sense. And of course, MIT merchant initiated transaction versus customer initiated
Yeah, I'm not doing
transaction.
a good job not using these
For
buzzy payment
those
terms.
just following along at home, I want to talk about tokens in a minute, but I think one other point on kind of the orchestration involved. Certainly, what we've seen here at Rainforest is not only the redundancy you're talking about, but also portability. And I think that's something that I don't see talked about enough. I post a lot about portability, but especially for software platforms being able to have their tokens be portable, but also have their merchant data be portable. And we're doing migrations now with software platforms that have thousands of merchants. And we just did one this week where they flipped a switch and all of a sudden all the data is replicated over to Rainforest. And so a migration that might have taken many months before can now be done in a matter of days or weeks. And so I think that's a really good use case for these types of solutions, is making sure that you have control of your data, for the long term. And that gives you better leverage over your current payments partner. It also gives you the flexibility to use multiple and that redundancy later. So I tell anybody, whether you're using Rainforest or not, you should be looking at ways to control your data. And certainly given the sensitivity of a lot of this onboarding data or payment data, unless you really have deep experience in building PCI vaults, you don't want to do that yourself. You want to use a solution like a basis theory to do that. So I think we've got a lot of philosophical alignment there.
Yeah, I mean, you and I have been talking about this since day one, right? I mean, I remember you and I were throwing around the idea of bringing to market some sort of like data portability pledge. Like, I still
Yeah.
think it's a great idea. I appreciate when you first launched Rainforest. I remember somewhere in your terms of service or somewhere, I mean, you explicitly call out, hey, this is your data. Here's how you leave us. When we first started Basis Theory, we used to have something on our homepage, which, you look back at it now and it's somewhat cheeky, but like, I think it's a good indication of the stuff we were thinking about from day one. We had this basis theory prenup, and it was our way of saying, hey, we actually built a guide for how to leave basis theory. And so whether we're talking about this from a contractual aspect or a actual operational aspect, this is your data, and we will show you how to leave us if you ever do. And I think there's a lot of other benefits to that, namely like it holds you and I accountable to delivering the best possible service we can to our customers. And the onus is on us day in and day out to continue to provide that sort of customer service. And I think that's like this benefit of this that's not talked about enough. But I know you in particular can appreciate that.
And the reality is, unfortunately, even in mid 2025, there are still a lot of legacy acquirers that hold people's data hostage. We have a client now who's going through that, and you'd think we'd be past that by now in the industry, and yet that's still where we are. So still a lot of room to go on that. That brings us to our next topic, tokenization, because that I think does help portability quite a bit. You recently, Colin, made a comment on LinkedIn, and you said it's both obvious and inevitable at this point that all payment credentials will eventually be tokenized. What exactly does that mean, and why is it important for software companies and embedded payments?
Yeah. So look, first of all, obviously that comment was somewhat self-serving, so I will admit that. But the impetus behind that was obviously last week, both Visa and MasterCard, as well as PayPal and all these other folks, came out and launched their agentic commerce solutions.
What is agentic commerce right now? Because I hear people talking about that term. A lot of people haven't heard it or don't really know what it means. So let's define that for a minute.
Yeah, I think that people are conflating commerce inside of AI ecosystems with agentic commerce. And so I think we should actually start there if we want to go down this path, which is, I think if you look at shopping trends in e-commerce over the past 5 to 10 years, like it has shifted more social as a trend, right? Think TikTok links, Instagram links, these types of things. No social platform has ever grown as quickly as ChatGPT and some of these AI ecosystems. So there's a natural evolution of shopping or commerce will move to the next social platform, which just happens to be this billion plus user platform, which is ChatGPT. Okay, great. But that is not agentic commerce. I think agentic commerce is actually empowering these underlying agents to transact on your behalf. And when I say that out loud, I hope people that are listening actually get a little bit afraid of that comment, because that means we need to trust these agents with things like intent, authorization, identity. I mean, there's a lot more to agentic commerce than just payments. And this was evident in Visa's product drop. I don't know if you saw it, but like they are thinking about those things. And so, look, again, probably a topic for a whole separate podcast, but that is the fundamental underlying idea, is how can we empower these agents to actually transact on our behalf? Now, again, from there, I start to go down, well, are we talking about luxury goods? Are we talking about commodities? Like, how does this impact, merchants and all of these other things, which is fascinating, but that's where I'd say. Anyways, going back to your point, as part of these launches around agentic commerce, which are heavily relying on tokenization, Visa basically came out and reported that last year, 50% of transactions on the network were tokenized. Now, again, that number is a bit exaggerated in terms of what's actually happening there. What's really happening is a lot of the PSPs behind the scenes are leveraging network tokens. The merchants, the platforms are still passing raw PANs, processor tokens behind it and all that. It's a big number nonetheless. And I think what they're saying is we are going to have an increased intentional strategy around getting that from 50% to 100%. Similarly, MasterCard has come out and said by 2030, at least in Europe, PANs are going to be gone. Like there will no longer be this concept of PANs, personal account numbers, right? The 16 digits that are on your credit card. All of that to say, and whenever I talk about this, I always envision like Kaiser Sose from Usual Suspects and his quote about like the greatest trick the devil ever pulled was convincing the world he didn't exist. I think about it in terms of the greatest trick all of these payments companies ever did was convincing people that tokenization was for data security. Like it is a data security mechanism or technology, but in a lot of cases, it's being perversely used as a lock-in mechanism or a tactic, to your point, around making it difficult to migrate off their platform, to leverage third parties and really be heavily reliant on that current provider, which I think is a shame. If the industry actually cared about data security, customer privacy, like there would be some sort of like ubiquitous token spec that everyone was building towards so that Stripe could understand what Adyen did and Adyen could understand what Visa did and Visa could understand, you know what I mean? But like that doesn't exist. And so the reality is, as this data is getting passed around the ecosystem, it's being tokenized and detokenized, and the plain text is being exposed over and over again. And so again, if we want to think about it from a first principles or KPI perspective, the industry would actually look at it from like, how can we take the moment a piece of data on the internet gets created, track that over its lifetime, and reduce the number of times the plain text ever gets exposed? That would be the way to think about it, but that's not how it works.
Yeah, and I think the reality is where rubber hits the road with regard to tokens, as an industry, we still have a long way to go. Even things like provisioning tokens and being able to use them for the first transaction, a lot of issuers are not provisioning those tokens fast enough to be used in the first real-time authorization message.
It's like 10 seconds, and that's a non-starter in the context of e-commerce.
And so there's kind of fundamental problems and challenges still with tokenization adoption, and no doubt we'll get there. But this kind of sheen of, well, do network tokens and you'll get 10 basis points off of a lot of your Visa transactions. There's a long way between that and when you actually sit and talk with people who are using them. There's very limited scenarios where they actually apply. There's very limited scenarios where there's cost savings. And so I think still early days, certainly from my perspective on tokenization.
And if you remember when the networks first started coming out and talking about these network tokens and, to your point, the associated interchange benefits and such, one of the rules they were trying to push out was you only get the interchange benefit if you purge the PAN from your system. Like that would, and the merchants pushed back so hard. And they were like,
just a non-starter, right?
Totally. And so to your point about software platforms, sorry, like I was just sharing with you before we got started, we were at this dinner earlier this week and this exact topic came up. And I think without saying who it was by name, there was a software platform there that was considering a change with their payments partner. They put months of work into it, modeling out the benefits. And what they ultimately concluded was there's no way they can do it regardless of how aggressive the new party can be on pricing, because they were assuming a minimum of a 10% breakage fee on their back book in that conversion. And they just couldn't stomach it regardless how aggressive they could be. And like, it was just such a stark reminder of how locked in that platform is with their current partner, because they didn't have the hindsight to think about this stuff in advance. And then someone else brought up, which I hadn't even really thought about, the journey of, let's just say it by name, Payrix, right? I mean, Payrix has gone through so many evolutions of ownership and changing platforms, even inside of existing ownerships. I think they said, if you've been on Payrix since the early days and you're still on them today, you would have had to go through 5 back-end hard-coded migrations to continue that upkeep. And it's just like, at every point along the way, I'm sure those customers looked at alternatives, but couldn't even execute or act on it.
Yeah, the one thing I'll add though is with merchant portability, it's never too late to start. It's like losing weight. You would have been better to do it 100 pounds ago, but you got to take that first step. And all of the platforms that don't have any of their merchant data have a tough thing to squeeze through right now, so to speak. And so we've got to get them to a point where they start collecting that data. And the best time to do it is yesterday, but the next best time is today.
Totally.
We've got time, Colin, just for one final point here. So you on LinkedIn have posted about Payments 3.0. Payments 1.0, you kind of talked about, is legacy acquirers. These are the Vantivs, the WorldPay, the Global Payments. They're serving the legacy enterprise merchants. Think Macy's, Walgreens, Walmart, what have you. Payments 2.0, the arrival of modern PSPs like Braintree and Adyen, Stripe, Checkout. They were really built and grew off the base of serving modern high growth merchants like the Airbnbs, the Ubers, Spotify's, Netflix of the world. Talk to us about Payments 3.0. What do you see as Payments 3.0?
So I think about Payments 3.0 in the context of the ultimate evolution of 1.0 to 2.0. So those, to your point, Payments 1.0, all of those various payment processors that you just mentioned, what did they have in common? They were part of a financial institution, right? They used to be highly coupled. Payments 2.0, the arrival of these modern PSPs, which mostly set up as payfacs and non-bank processors, payment gateways. It was the first time payment processing got decoupled from your financial institution, where you did treasury management and all of those things. But they were still full stack payment processors. And I think what we're seeing now is the next evolution of that, the next breaking down or decoupling. And so it went from bank plus processing to bank processor. And now what we're seeing is bank processor and all of these different third parties for you to build your own custom payment stack. It's the holy grail of all of this. What's interesting about it, and part of the reason, again, going back to why I started Basis Theory, is, and this is not the perfect analogy, but I think we can draw some analogies from crypto here, in that crypto is like the ultimate decentralized ecosystem. And what we're starting to see is that the payment ecosystem is becoming more decentralized. And I think what's most important for merchants and software platforms is to have a centralized approach to a decentralized ecosystem. Why has Coinbase and centralized wallet infrastructure been the primary driver of crypto? We still need to think about things like trust. We still need to think about things like compliance. We still need to think about things like having an intentional strategy to interact with multiple different rails. In some ways, what we're trying to do with our vaulting architecture and overall platform is deliver to our merchants a way to have a intelligent, inherent, and centralized approach to this new decentralized, decoupled payments ecosystem.
Payments 3.0, the final word. Colin, thank you so much for being on the podcast. Always fun to host you.
Love it. Thanks, Jay Money.